Good morning, all, and welcome to today's webinar on conditions in the ag industry. I am Carmiana Matson of the Federal Reserve Bank of Minneapolis. I'm here today with regional economist Joe Mahon. And before I turn it over to him, just a few housekeeping items this morning. Slides of this presentation and a copy of the video link will be emailed to all registered attendees next week. Today's webinar is part of a series of webinars that we do on regional economic conditions. I know many of you out there have attended several of them. We hope you will attend our next one after this, which is on conditions in the construction industry with Ron Wirtz. That one will be held Tuesday, December 3rd at 9 a.m. Central Time, and we'll drop a link to that in the chat. Joe will have some time at the end of his presentation for questions. So if you do have questions, please type them in the chat box on Zoom, and I will pose those questions to Joe verbally. And lastly, we'd love to get your feedback at the end of this presentation. So please stick around and take a minute to fill out the brief 3-question survey that pops up in your Zoom web window when you exit the webinar. And with that, I will turn it over to Joe.
All right. Thank you, Carmi, for that introduction. And thanks to everybody who is joining us out there virtually today. So I'll just be talking about the results of our latest survey of agricultural credit conditions in the 9th District, which is kind of a window into the state of the ag sector right at harvest time. The third quarter survey gives us a good look at how things are going at the end of the growing season. Before I get started, just going to share a standard disclaimer that my views are my own, and I have plenty of views, but I just want to make it clear that I'm speaking for myself and not for the Federal Reserve System or my colleagues at the Minneapolis Fed as well. So just to get that out of the way, and mostly I'll be keeping my views to myself and just sharing you the results of our most recent agricultural credit conditions survey. Before I get into those results, I'll give you a brief peek into the size and importance of the agriculture sector in the 9th District. As we know, our region is heavily rural and agriculture is a pretty important industry. So I'll give a quick overview of those before I get into the results of the survey itself, a little bit of background on the survey as well. And just so as not to keep you in suspense, I'm going to give you a kind of quick summary of the results that we got from the third quarter of this year, which again was conducted just as harvests of corn and soybeans were rolling in after the wheat harvests were mostly completed. What we found is that it was overall a pretty negative survey. Farm incomes are down year over year, overwhelmingly across the region, and some of our indicators of financial conditions of farms weakened as well. Demand for loans went up, repayment rates went down. I'll get into those results in a minute. Land values, though, farmland values continue to go up generally across our region at a slower pace, though, than we've seen over the last couple of years. And the outlook for the last 3 months of this year, which we ask about in the survey as well, is for continued decline in farm incomes. So that's kind of a sort of summary of the results before I get into the nitty gritty. But just to give you a quick reminder, if you haven't joined us for one of these webinars before, if you're not familiar with the 9th Federal Reserve District, that's the region that we represent at the Minneapolis Fed. It covers the states of Minnesota, North Dakota, South Dakota, Montana, and then you can see we have kind of the northwest portion of Wisconsin and the Upper Peninsula of Michigan. So this region, excluding maybe the North Woods and most of the UP, is a heavily rural or heavily agricultural region. And so ag is a pretty important sector in our district. One quick plug, Carmi mentioned at the outset that we do have more of these RECs coming up, these regional economic conditions webinars, and my colleague Ron Wirtz will be doing this one on the construction industry, also another pretty crucial sector in our region, coming up in a couple weeks here. So a quick look into ag and its relative importance in the 9th District. This is just kind of a breakdown of GDP by industry for 2023, so just the most recent year for which we have data for the full year. And I've kind of added all the 9th District states together to get a GDP for our region. And you can see the broken slice of the pie, this slice of the pie that's broken out here is what agriculture represents as a share of GDP. Now, I want to make clear, this is the way that we measure agriculture in GDP statistics is we're just looking at production agriculture. So the production of crops, animal products, things like that. It doesn't include a lot of the crucial industries that depend on and support agriculture, like agricultural services, transportation, food processing. If you were to account for those, it would be a much larger share, but those fall into other sectors the services and manufacturing sectors. So just looking at production agriculture in our district, it's still nearly 4% of our output and a much larger share of our output than for the US as a whole. So you can kind of see the importance. And just to kind of put some numbers on it, I like to show cash receipts from farm marketings from agricultural commodities. And you can see that those represented for the most recent year that we have data, 2022, more than 70 billion, almost $80 billion of cash receipts from ag commodities in our district states. It's a pretty large industry, and like I said, it supports many other businesses and communities, even beyond the impact within farming and livestock production itself. So that's part of the reason why we do this survey. What is the survey? Well, this is a survey we do on a quarterly basis. We have a lot of bankers in our region who support agriculture, who provide credit to agricultural clients, ag-specific loans like operating and machinery loans. So we have a good opportunity with these member banks who are concentrated in agriculture to kind of check in with them and see what's happening in the industry in their communities. And I want to make it clear, I always try and clear, even though we're calling it a survey, this is really more like an expert poll. If you think of it, these are bankers who know this industry very well. They know their clients who are in agriculture very well, but it's not a random sample. We're not randomly polling contacts in the industry. It's more like a panel. I would think of it that way. And we have across our region 54 state member banks in our region who are concentrated in ag, who responded to the survey in October. We do these surveys on a quarterly basis. We ask what happened in the last 3 months, and we ask what expectations are for the coming 3 months. And when we conduct the survey after that quarter ends. So for the third quarter, which covers the months of July through September, we actually conducted this survey in October. So it's a good peek into what's happening right at harvest time. And again, kind of the headline results here. Generally decent financial condition, although some indicators of weakening financial condition. Incomes, though, are down overwhelmingly across the region. Farm incomes are down. Capital spending and household spending are also down. Purchases of equipment and machinery by farms and is down. And actually, the consumer spending by farm households is overall flat. I'll show you what those results look like in a minute. One good bit of news is that we've seen some decline in interest rates, kind of coinciding with the loosening of monetary policy and decline in interest rates. Generally, agricultural interest rates tick down slightly, and that'll be some relief because they've been climbing for the last couple of years. Along with that, we've seen an increase in loan demand. That's what we would expect given the tighter cash picture that farms are facing. They have higher demand for credit. The rates of repayment are going down. I want to make it clear that doesn't necessarily mean that farm operations are defaulting or going delinquent on their loans. It just means they're not repaying them faster than schedule. So that's kind of what we ask about in that question. Again, as I mentioned, some indication that land values and also cash rents even more so are continuing to climb through the third quarter, and the outlook for the next quarter is negative. So kind of give you kind of a breakdown of what the income and spending picture looks like. You can see 85% of the lenders that we surveyed told us that farm incomes decreased in the third quarter. And this is relative to a year earlier. So we asked what happened during those 3 months from July through September compared to a year ago. 85% of these lenders surveyed told us that farm incomes were down. Household spending a little bit more flat, slightly higher share telling us that they increased compared to decrease, but the largest chunk of them telling us that incomes didn't change. And then capital spending down as well, not as overwhelmingly as agriculture, but it is down. And that's not surprising given the tighter cash picture that we're seeing some belt tightening when it comes to investment in equipment and buildings and machinery. To put some historical context on this kind of gives you an idea, a picture of what the longer term income pattern is. And this is all based on survey results going back to the mid 1990s. And I'm just showing you the share of the survey respondents that told us that income either increased or was the same year over year. And you can see that this portion of respondents telling us that incomes increase has plummeted over the last year. Actually, the last year and a half, it really peaked kind of in late mid 2022. And so that's really kind of the period over the last year or so. We've seen conditions really reverse. Pretty strong income picture prior to that. Just after the kind of the shock of the pandemic, commodity prices were pretty high. And this is pretty closely tied to agricultural commodity prices. When commodity prices decline, incomes decline. They can decline for other reasons, but that's really what the primary story here is, that prices for corn, soybeans, and wheat, and a lot of other agricultural commodities have been declining for almost 2 years now, and that's weighing down on incomes. Getting into the kind of financial picture, you can see that the largest share of lenders told us that there was an increased demand for loans from their agricultural customers over the last 3 months. 48% of them told us they increased, compared with just 20% that told us they decreased. Repayment rates, mostly stable. The largest share of lenders told us that the repayment rates were unchanged over the last quarter compared to a year earlier, but much larger share telling us that rates decreased about a little over a third. And then loan renewals, those agricultural clients rolling over existing loans and renewing them. That activity increased. About a third of them telling us that they increased. No one telling us that renewal activity decreased, which is again consistent with what you would expect to see during a tighter cash, higher demand for credit situation. As I mentioned earlier, we don't just ask what happened over the last 3 months, but we try and get them to give us a little forecast and look into what they expect to come over the final 3 months of this year, or the quarter ahead in this case, which is the last 3 months of 2024. And again, overwhelmingly, expectations call for a further decrease in incomes. 83% of the lenders surveyed told us they expected incomes to decrease in the fourth quarter of this year relative to Q4 a year ago. Picture for household spending. In contrast to what happened in the last quarter, largest share of respondents telling us that they expect a decrease in household spending as well. Household spending, that is, this is purchases of vehicles or other consumer goods by farm households. These have held up better even as the cash, as the income picture has weakened. Household spending has held up. So for it to have a kind of negative net expectation in the fourth quarter is notable. Capital spending, again, not surprisingly, given what we've been seeing, 70% of the lenders tell us that they expected to decrease further in the fourth quarter. And that's also consistent with what we're seeing in terms of the credit conditions. Almost 2/3 telling us that they expect an increase in loan demand in the fourth quarter relative to a year ago. More than half telling us that they expect a decrease in repayment rates, and renewal activity up as well. So all kind of pointing in the same direction of not just lower incomes, but incomes have been low enough for a long enough time that it's starting to bite into household finances. Those cash cushions that they built up during the high income periods are starting to wear down. And that's consistent with the special question that we asked during this period of the survey. We asked about farm borrower liquidity. And again, you can see over the last 3 months, 85% of the lenders we surveyed told us that they saw farm borrower liquidity go down. That is cash on hand. You can think about it that way. Very small shares telling us that liquidity remained the same or went up. And the expectations for the coming 3 months are nearly identical. 81% telling us they expect weakening in liquidity among farm operations in the coming 3 months. So again, that's consistent with the period of persistent low incomes. You expect those cash cushions to be worn down. One little bit of good news that I can point to is there was some relief on the interest rate front. You can kind of barely see it in this chart. This is just showing you the survey averages. We asked these borrowers, this is a pretty good question to ask them, is what are you charging on interest rates to your agricultural customers? And overwhelmingly, those have been increasing over the last 2 years. That monetary policy has been tightening. All interest rates really generally have been moving up. And you can see that happen over the last couple of years. And what happened in the most recent quarter was that there was some tick downward in agricultural interest rates, most of them just moving down by about 1/10 of a percentage point or 2/10 of a percentage point. And that's true both on a fixed interest rate and a variable rate basis for machinery and operating loans. And then also, I'm not showing it here in this chart, but we ask about real estate interest rates as well, and those are down by about the same amount. Again, as with all these other results, you can find this on our website when that article is published later this morning at minneapolisfed.org. One last thing I will leave you with before we get to questions is just to kind of check in on the land values. So one of the questions that we always ask about on the surveys is what happened to the price of an acre of good agricultural land in your area compared to a year ago. Or actually, we just really, the way that we ask it is we just ask them what an acre of land is going for, and we can compare it to the survey results from a year ago. And what we found was across the district, agricultural land increased by more than 2%. So that's an increase, but I will put it in the context of the last couple of years. It's a lower rate of increase than we've seen over the last couple of years, where land prices were really growing pretty strongly. And actually, if you look at the state by state results here, I don't want you to read into those too much, and I'll explain why in a moment. But actually, the land values in Minnesota decreased slightly year over year. That's just kind of based on the lenders that responded to the survey in Minnesota that responded a year ago and kind of giving an apples to apples comparison. Slight tick downward in land values here. I don't want you to read too much. You might be looking out on the margins of this map and noticing a 40% increase in Wisconsin, a 45% increase in Montana. I do want to caution that the sample size in those states is pretty small. We're talking about just a few lenders. And then when we're looking at comparing this ones that responded a year ago to this year, it's a pretty small number. And so, but it is worth noting that this is a comparison to what the same people told us a year ago. So in those particular areas where people responded, seems like land values are up quite a bit, but on average across the district among all the lenders that we surveyed, 2%. And you can see the values in North Dakota and South Dakota are consistent with that. Slightly higher rate of growth in cash rents, which is a little bit surprising because over the last couple of years that we've seen really strong growth in land values, we've seen weaker growth in the cash rent for an acre of farmland. So if you're a farm operator and you want to produce on land adjacent to yours, that's owned by someone else, you sign a rental contract with them, and that's a regular cost of doing business. So you can think about this as being a cost of business for agricultural producers. And what you can see is that we've got about a 5% increase on average across the district, 2% Minnesota, a little bit higher rate of increase in North Dakota and South Dakota than in Minnesota. And so that's kind of moving in the same direction as land values, which is, as I mentioned, kind of a bit surprising because those rents over the last couple of years have been growing a little bit less, and that's consistent with what you would expect to see in an environment where crop prices are weakening. The value of what can be produced on an acre is going to be lower, and so you'd expect the rent to go down. But I will point out that harvests were pretty strong this year, so that could have had something to do with it. It was, generally speaking, across our region, a good growing season. So in any case, we ended up with a picture with higher cash rents, growth in cash rents, that is, than land values. And overall, that's kind of that's the sort of picture from the survey. You can see more results on our website. Overall, not a very sunny picture that we're seeing. Hopefully, some change may be ahead in terms of commodity prices or in the market. And with that, we'll turn to questions.
Yeah, we do have some questions popping up in the chat, so please feel free to type any questions that you have for Joe in the chat. Can we just elaborate a little bit more on that last point, Joe? You said it's pretty pessimistic report. So what are the bright spots we should take away?
Yeah, I don't mean to give it a uniformly pessimistic picture. So there's a couple bright spots I'll point to. One is, even though crop prices are down and that's pushing down on agricultural incomes, livestock prices have been pretty strong, particularly cattle prices. So particularly further west in our region, in Montana and the western South Dakota, western North Dakota, where there's a lot more cattle production, respondents there were a little bit more optimistic because their livestock producers, their cattle producing clients and ranchers are doing a lot better. And they're actually benefiting from lower commodity prices because for livestock producers and dairy producers, corn is an input, soybeans are an input. And so that means their costs are lower for production, or at least part of their costs are lower. And that's pushing in the direction, along with higher livestock prices, of better income. So that's one sort of relative bit of optimism that I'd point to. The other thing I would point to, as I just mentioned a moment ago, you might think back over this past summer in your area and remember that we got a decent amount of rain. And this is coming off of a few years of drought conditions, persistent drought conditions in a lot of our region. This year was actually a much stronger growing year. In fact, In some areas, they suffered from flooding, which wasn't good news for those areas. But overall, good growing conditions in our region. And in fact, lots of rain early in the season, lessening of precipitation at harvest time, which is really what you want if you're a corn producer. It helps dry out your crop. So crop production conditions generally really good. And the indications that we have from the USDA was that crop production was pretty strong. We got a number of comments on the survey to that effect as well. Now, that's kind of a double-edged sword. On the one hand, higher production is going to offset some of those lower prices. So even though the price of a bushel of corn is lower, you've got more bushels to sell. That's good news. But since everybody saw higher production, that means there's more supply coming onto the market. And there's already a lot of inventory sitting in storage, holdover crop from last year, that people were saying, well, I'm going to wait to sell this until the price turns more favorable. And so that's just adding to the existing stocks of those. So unfortunately, if you read the tea leaves a little bit, or the corn husks, as it were, you might look into the near future and think that the market conditions don't necessarily favor a rebound in prices because there's so much supply coming online. So, like I said, it's a double-edged sword. I think that producers will take it, but it's probably not going to do much to change the commodity price picture for the near term.
And related to that, Joe, there's a questioner in the chat asking, with commodity prices so low, can we forecast when we think land values and rents are going to begin to decline?
I would love to be able to do that. I'll just say as a side comment, I follow the land values, the land market pretty closely for some other work that I'm engaged in and just for my own academic interest. Um, and I will say we saw a big increase in land values in the early 2010s when farm incomes were really strong. And then crop prices declined quite a bit and agricultural incomes declined starting in about 2014. We had a period of about 5 years of very weak farm income. And actually a lot of exits from the industry. It were pretty tough conditions. And there was only a slight retreat in land values. We were expecting at some point some reversal, some correction in the market. And there was. And if you look at land values over time, you can see they started to decline around, we'll call it 2017. But then once prices came back up, land values climbed right back up. So it's kind of hard to predict because if you think about the price of an acre of land, it's not just a reflection of what can be produced on it, the value that can be squeezed out of it this year, but it's a long-term projection. You're thinking about decades into the future that's going to go into the price of that land. And so it doesn't have as quick of an impact as you might think.
Thanks. We also had a couple of methodology questions pop up in the chat. There's a questioner
Nice.
who's wondering, yeah, I knew you'd like that. You mentioned this is a pretty small sample size. So, do we have a way of knowing what percent of capital those surveyed banks are providing to ag? Do we know that we're getting a good snapshot of that?
That's a really good question. I don't know that offhand. It's something that I could look into. That would be kind of a little research project to do. I can say just sort of qualitatively that it's going to be small because we're talking about our member banks, and like I said, there's a little bit over 50 of them in the region. There are a lot more community banks and agricultural banks in our region that are not Federal Reserve members, that are state chartered banks. And so I would guess that. And by the way, there's also non-bank lenders to the sector as well. If you think about the dealer credit and things like that, so that's going to be part of the picture as well. And then the farm credit system is in there as well. And so you add all those together, and it's going to be a pretty small share of the total capital in lent to agricultural customers.
Another methodology question, do we know if the results apply equally to large farmers versus small farmers, family-owned farms versus corporately
Yeah.
owned farms?
I'm going to say offhand, and we don't ask about borrower size in the survey, so we don't really know. But over the last few decades, the average size of farms has continued to get larger, and these are operations that are drawing on pretty heavy lines of credit from their banks, and so these are all going to be, I think, generally pretty large operations. I don't think you would want to read these results for the district as being an indicator of the condition of small family farms, because frankly, there aren't that many of those that are large players in the market. Most farming operations are pretty large business enterprises.
Thanks. We do have a question in the chat about the recent election and what effect that might have on some of these factors, in particular the idea of introducing tariffs. Do we know what that will do?
So that's a really big question. My short answer is we'll just have to wait and see. I will point out one really important sort of qualifier here. This survey was conducted in October prior to the election. So at the time that we did this check-in, the lenders we're responding to did not know the outcome of the election. Now they might have been guessing, and we did in fact get a couple of comments sort of related to tariffs from the lenders in the survey. But I wouldn't read too much into those. I will say keep your eyes peeled for our fourth quarter survey, because we might get a little bit better read on the sentiment there. The other thing I'll point out, we do have recent history of escalation in trade tensions between the US and China. And we know that during that sort of nascent trade war, China levied some retaliatory tariffs on the US that were heavily targeted at agriculture, sort of for strategic purposes, along with some other sectors. And the government responded at that time by providing extra sort of trade-related assistance to farmers, so essentially kind of offsetting the effects of those tariffs with some subsidies. You might expect to see something similar. Now, I want to point out that a lot of my contacts in the industry said this isn't how we want to be making money. We would like to be selling crops rather than getting checks from the government. But I would expect that you might see some sort of policy response to negative impact from tariffs in sort of upcoming farm policy bill.
Thanks. Got lots of questions that have popped up in the chat. We're running short of time, so let's take one last question here. Let's see. Would you consider these decreases in income and interest rates precedented or expected in tandem, considering the 2022 increases in ag expenses and income?
Yeah, I would say that this is not a surprising result in this survey. So, and I don't mean to be packaging them as like, wow, this is really shocking. First of all, because we've seen incomes declining for a couple of years, we know what's happening. You can look at the price of corn and soybeans every day and compare them to what they were 2 years ago, and so we know that that's going to have a negative impact on incomes. As the questioner mentioned, I'm really glad that they did. The cost of production has gone up quite a bit. Even though we've seen some relief recently on diesel prices and things of that nature, there was a big escalation during the same period where crop prices were climbing. The input costs were up as well. Everyone is sort of experiencing inflation or has experienced inflation over the last couple of years, and that's true of farmers as well. And so that was compressing farm incomes as well. So yeah, this is not really terribly surprising that expenses are up, prices are down. That's going to add up to lower incomes. And so, yeah, I would say that this is not super shocking.
Thank you, Joe, and thank you everyone for joining us this morning. As we mentioned, we will be sending out a link to Joe's slides and a copy of the video for this webinar sometime next week. And we encourage you all to join us for our next webinar on December 3rd, which is on conditions in the construction industry. Thanks so much for joining us, everyone. Have a great day.
Thank you.